Welcome to the Explainer. Today, we're doing something really fun. We're putting on our expert investment analyst hats to run Fastenal through what we call the valuation gauntlet. We're going to see if this incredible business, which is totally known for its unmatched supply chain services, is actually a smart investment for your portfolio at today's prices, or if it's kind of just a value trap waiting to spring.
Here's our quick roadmap for the gauntlet. First, a Fastenal snapshot. 2, the Buffett lens. 3, the Lynch and Graham lenses. 4, a discounted cash flow analysis. 5, some alternative models. And finally, number 6, our final verdict.
All right, let's dive into Section 1, Fastenal Company Snapshot, analyzing the core business.
So, what exactly are we dealing with here? Fastenal, under the ticker symbol FAST, is currently trading right around $44.76 a share, giving it a massive market cap of roughly $53 billion. And their second quarter results? Really impressive. They grew daily sales by 14.7% and pulled in just under $383 million in net income. Plus, they just bumped their dividend to about $1 per share annualized. Also worth noting, the company is wrapping up a 3-decade chapter, with CEO Dan Florness passing the reins over to Jeff Watts. With those baseline facts in our back pocket, let's see how the investing legends would grade this stock.
Moving to Section 2, the Warren Buffett lens, moats, management, and margins.
Now, you probably know Buffett loves a strong economic moat, consistent earnings, and rock-solid honest management. And Fastenal passes his qualitative checklist with flying colors. They're actively gobbling up market share, particularly with large customer sites. Their debt is almost shockingly low, just $120 million compared to over $4 billion in equity. I mean, that is the definition of a fortress balance sheet. And their return metrics, totally outstanding. Both their return on equity and return on invested capital just hit multi-decade highs of over 30% on a trailing 12-month basis.
To figure out intrinsic value, Buffett always looks for owner earnings. If we take their Q2 operating cash flow, which was roughly $266 million, and subtract about $60 million in capital expenditures, we're looking at a quarterly free cash flow of over $200 million. Annualize that, and we calculate approximate owner earnings of around $800 million. That's a staggering amount of cash being generated, giving us a great anchor for his valuation.
Section 3, the Lynch and Graham lenses, growth versus hard assets.
So Peter Lynch likes to categorize companies into buckets. Think fast growers, stalwarts, cyclical plays. And he relies heavily on the PEG ratio to figure out if you're paying too much for future growth. Ideally, you want a PEG ratio of 1.0, which means the stock is fairly valued relative to its growth.
The big question here is Fastenal a fast grower or a stalwart? Well, growing sales at nearly 15% is fantastic, but it currently trades at a price-to-earnings ratio over 40. When you divide that sky-high PE by its 15% growth rate, its PEG ratio lands well above 2.7. So in Lynch's eyes, this is definitely not a cheap fast grower, it's a very pricey stalwart. And yes, their balance sheet is flawless, but without any compelling insider buying data or super low institutional ownership to offset that high price, you're absolutely paying a hefty premium for that growth.
Now let's bring in Benjamin Graham, the undisputed father of value investing. Fastenal does pass his defensive investor tests for earning stability and a solid dividend record. But his intrinsic value formula is brutally uncompromising. We need 2 numbers for his formula: an estimated trailing earnings per share, which is roughly $1.30, and book value per share, which we calculated at $3.54.
Just to show you exactly how we got that, looking at their Q2 balance sheet, you can see their outstanding share count is just over 1.14 billion. When we divide their $4 billion in equity by that specific share count, that's how we arrive at that exact $3.54 book value per share. So we plug those numbers into Graham's formula, the square root of 22.5 times $1.30 times 354. The result? Graham's deeply conservative intrinsic value comes in at just $10.17. With the stock trading around $45 today, Graham wouldn't just walk away from this one, he would literally run. For a strict defensive investor, there is absolutely zero margin of safety here.
Moving right along to Section 4, Discounted Cash Flow, Forecasting the Future.
To forecast free cash flows into the future, we have to set some baseline assumptions. Now, because our source material gives us raw financial data but leaves out specific long-term forecast rates, we have to make some reasonable estimates to fill in the gaps. We're going to assume an 8% discount rate, or WACC, and a 3% terminal growth rate to run our perpetual growth method.
We went ahead and built a sensitivity table to show how tweaking those variables changes things. Notice that right in the middle, our base case DCF, using that 8% discount rate and 3% growth rate, puts the fair value per share right at $45. That is practically perfectly aligned with the current trading price of $44.76. Honestly, it's wild how the market seems to have priced this stock with almost robotic efficiency.
Section 5. Alternative Valuation Models, Dividends, and Wall Street.
We never want to rely on just one model, right? So let's look at the dividend discount model first. If we take that newly raised annualized dividend of about $1, apply our 8% discount rate, and assume a really healthy 6% dividend growth rate, the model suggests a fair value of $50. What's actually fascinating here is how remarkably close that is to Wall Street's consensus price target of $48.83, which is an average pulled from 13 different analysts.
But if you've got the patience to zoom way out to a 10-year time horizon, the picture gets pretty exciting. Ticker's model suggests some massive upside by 2034. Assuming their digital penetration and double-digit daily sales growth just keeps chugging along uninterrupted, their base case targets $90 a share. That represents over 90% upside from where we are today.
Okay, Section 6. Time for our final synthesis and verdict.
Let's put all of these valuation lenses side by side. It is a really stark contrast. We know the current price is hanging around $44.76. Graham's model completely rejects it at around $10. Lynch thinks it's a pricey stalwart with a peg over 2, but then the DCF and dividend model suggest it's actually priced almost exactly right, hovering right there in the $45 to $50 range. Look, Fastenal is without a doubt a phenomenal business. The strengths speak for themselves. Unmatched 30+% returns on invested capital, incredible cash flow, and serious market share gains. But you can't ignore the risks. You're paying a huge PE premium, they are dealing with some ongoing price-cost margin headwinds, and again, there is absolutely 0 gram safety margin.
So, blending all of these insights together, our final verdict is a solid hold. It's an incredible business that just happens to be trading right at fair value today. What would it take to trigger a buy? Well, Buffett might scoop this up if it dropped to around $35, just to get a decent margin of safety on those owner earnings. But Graham, he wouldn't even look at it unless it completely crashed down to $7 or $8.
I want to leave you with this final thought. Fastenal's execution is an absolute masterclass in supply chain services and capital allocation. But as an investor, you really have to ask yourself, are you willing to pay today's premium for tomorrow's perfection? Thanks for joining me for this explainer. Keep crunching those numbers, and I'll catch you next time.